Welcome to the next edition of Pizz-Spectives. My name is Rob Pizzichetta, founder of Mont Wealth, and we're excited today to talk a little bit about infrastructure and how it will power artificial intelligence and economic growth. And to be honest, I believe that infrastructure investment will outperform the market over the next few years as we start to see these trends drive continued growth. But before we start, I'll touch on the general advice disclaimer. Any information that we discuss today is general nature only and has been prepared without considering your relevant personal circumstances. Those acting upon information without first consulting a financial advisor do so entirely at their own risk. But to start, let's talk a little bit about why growth in AI and data demand will drive a need for infrastructure investment, how Trump's tariffs will drive an increase in manufacturing supporting US assets, which sectors within infrastructure will be the largest beneficiaries, and the expected rate of return for infrastructure going forward. So without further ado, I would like to introduce Devin O'Keefe, Business Development Manager at ClearBridge Infrastructure. So welcome, Devin.
Thanks, Rob. Thanks for having me.
Pleasure. Now, let's get started. Let's talk about why infrastructure now before we get into the process, because we really want to understand what the fundamentals are and what's driving the growth in this space.
Yeah, sure. There's a lot going on in infrastructure at the moment, Rob. It's a little bit unique for a sleepy asset class for the last couple of decades. It's actually quite exciting. We're seeing significant growth in electricity demand, Rob, at the moment. We're seeing growth that we haven't seen really since the rise of air conditioners. A lot of that has been driven in the last, honestly, couple of years, 2 to 3 years since the rise of AI. I know everyone on this call and everyone that'll listen to the follow-up recording in some way, shape, or form has been touched by AI already. We also are experiencing the decarbonisation transition as we transition away from geothermal energy into renewable energy. There's a significant change that'll take place in utilities across the world there. And we're also seeing the reindustrialisation, or reshoring as we call it, of supply chains taking place globally, especially in the US, which we have to talk about further as well. So we'll probably see the utilities and electric names that we have in our portfolio and globally continue this growth trajectory into the next probably 2 to 3 decades. Certainly in this next decade, they'll go through some pretty substantial changes. Looking at, I suppose, the midstream and pipelines, gas and oil are pretty unloved subsectors of infrastructure. No one really wants to talk about gas, especially here in Victoria, where I'm based, obviously you're based as well, Rob. So I think we've seen that asset class or subsector really over the last probably 10 years be given a zero terminal value in terms of its. So gas will certainly provide that stopgap in the meantime. And again, when I say meantime, we're talking probably a decade and a half. So we think there's really good opportunities there. Communications is another subsector that people don't really think about too much. Again, it's relatively consistent in terms of its performance. The demand for data, we'll touch on that further as we go into this webinar, but the demand for data is there. The 5G transition is certainly taking place. Australia's probably got a better reliance on 5G than what we do NBN at the moment. So that'll continue to grow globally. So we're confident that the sector is going to continue to have that attraction to it. Over the last probably 10 to 15 years, the cost of air travel reduced by about 35%, representing a really good opportunity for airports leading into COVID in terms of people wanting to travel. It was pretty cost effective to travel. Obviously, off the back of COVID, there was obvious headwinds to travel transport infrastructure and airports. And post-COVID, we've seen that the cost of travel has risen now by about 50% in 2 years. So it's caught up to that 35% reduction and then some, which meaning it's almost more expensive than ever to travel. That being said, people are still certainly traveling. People off the back of COVID have probably realised that life's too short to be stuck at home, so they want to still take place and still experience that travel experience, which is brilliant. We call it revenge travel, and that's still certainly got a fair way to play out. Some other asset classes, Rob, I don't want to dive into them too much detail, but water is a really interesting one. If you think about UK and the US, some of the water pipelines in UK are 80 to 100 years old. So there's going to be a significant CapEx cycle take place in water where the companies there will, increase and relay the pipelines and increase efficiency of these pipelines, which will help drive some of their free cash flows that they'll experience over the next kind of decades, and certainly increase their allowable returns, and even looking more looking beyond that next year. People still need to turn on the heating. People still need lights. People still want to travel. So we think there's really good upside for a lot of those asset or sub-asset classes in
Yeah,
infrastructure.
exciting stuff. So let's focus on the really exciting sector within the infrastructure asset class, which is the power demand that is going to explode, pardon the pun, in the next 10 years or so. So let's talk a little bit about AI and the demand for electricity.
Yeah, it's interesting. As I said, we haven't seen demand like this in electricity for, I don't want to give away my age, but certainly in my lifetime, we haven't seen this type of demand. It's really exciting for us. Historically, the energy markets year-on-year growth and baseload growth has been relatively flat, if not negative. Over the last 10 years, it's been relatively flat, if not negative. So we're now seeing that load growth expect to grow. Our expectations are around, and our company's expectations are around about 5% in the next several years. And if we put that in kind of local terms, 1% of baseload generation and growth, sorry, in the US is equivalent, roughly equivalent to Australia's whole energy usage. So every percent the US goes up, that's another whole Australian energy grid that they would need to develop and deploy in the US. So it's a lot of energy and it's pretty significant. And a lot of that growth has come off the back of AI and data centers. But in the next 5 years, AI data center growth and spend is looking to be from the large names, so your Googles, your Amazons, your large tech companies, to be about $1 trillion spend in about the next 5 years on data centers alone. Right now, data centers account for, give or take, about 2% of energy used in the US. So that's expected to grow to about 10% by 2030. So that's pretty significant opportunities for us and our names. Where's that power coming from? As I said, we don't want to be, as mums and dads globally, competing with the likes of an Amazon that really don't care what they have to pay for energy. So what we're seeing is a lot of these names in our portfolio accessing power from what's called behind the meter. Recently, we've seen companies like Constellation Energy. They've just entered into a long-term offtake agreement with Microsoft to actually reignite a decommissioned power station by the name of 3 Mile Island in Pennsylvania. It's a really exciting project for them. Microsoft is funding the rebuild of the power station. They've then signed up to a 30-year behind the meter offtake agreement at around about a 60% premium on energy provided to what the average mum and dad would pay. And what that means is that before the energy is even pushed into the grid and the broad market, Microsoft will have access to the energy, and then anything that's left over gets pushed back into the mum and dad energy retail market at, give or take, right now it's about $60 per megawatt hour. Microsoft will be paying about $100 per megawatt hour for that energy that they're getting first rights to. Mum and dads won't necessarily need to compete with these big names. We'll see that even at a base load scenario, which you can see here in the graph, Rob, that we'll see that energy demand is significant. As I said, we're likening to Australia's whole energy production at the lowest base case, at the biggest base case in terms of AI data demand, large language models, NVIDIA rolling out more and more energy intensive chips. Yes, they're more efficient, but they're more energy intensive as well. We'll continue to see that rise over the next, realistically, it'll be in the near term, so call it 7 to 10 years.
That's crazy to think the demand for electricity. So then as a result of that, and maybe we digress a little bit, how is the fund exposed to this thematic? How are you guys benefiting from
Yeah,
it?
sure. In almost every name, every electric utility in some way, shape, or form is benefiting from the power demand thematic that's taking place. As I say, it's not just AI, it's the reindustrialization of supply chains, it's the reshoring of supply chains. It's the old exam question, Rob, around if demand is outstripping supply, then prices go up, and who benefits? The people that are supplying the electricity. So that's the utilities that we're investing into.
We're on the cusp of some greatness in then for infrastructure assets. Have we started to see the earnings tick up for these utility companies, or is it just in its infancy that the market hasn't really priced it yet?
Yeah, the market's probably catching up to it, and have probably caught up to it since, let's say, about March this calendar year. So there's still a significant upside. There's a lot of meat on the bone, as they'd say, Rob. For us, the earnings growth has probably been noticed by some of the names. We've got arguably one of the largest teams in Australia looking at these names, looking at what will run next. So we can get in nice and early, and then when the market does catch up, Rob, we can ride that wave alongside some of those other long-only managers.
So then let's briefly touch on your process because it is important. How do you identify these opportunities? And I'd love to get my head around and understand a bit better how much of an Aussie exposure you might have or how much of it really is global and rest of the world.
Yeah, sure. Start with Aussie because the answer is pretty simple. Right now, it's next to zero in the portfolios that we have. So it's not to say that we haven't invested in Transurban and APA and the like. To be honest, there's just not a huge amount of availability domestically. So our approach is certainly a global one, which are our two flagship infrastructure strategies locally. So how we go about it, Rob, is we start with the whole universe. Let's say there's 600 stocks, 650 stocks globally that were a defined infrastructure. What we do is a little bit different to maybe some of the other managers in the market when they consider the infrastructure universe. But what we look at is quality of infrastructure. We look at the underlying assets themselves, and we look at them with a lens of like we would value an asset if it was in the unlisted market. So a lot of our team has come from unlisted infrastructure in the past. So when they're looking at these names, they're looking for, as I say, quality of the assets, predictability of the cash flow, and really how secure the asset is from an infrastructure perspective. So what that gives us, let's say, again, 600 names, we weed out around about 400 of those to build out what we call our rare infrastructure universe, our rare 200 universe, which gives us around about 200 names for us and our portfolio managers to then really drill down into. So from there, what we do and what our analysts do is they look at geographically, not on an asset breakdown, a sub-asset class breakdown. Our analysts don't just look at, for example, say rail, they'll look at Australia or APAC, and they'll look at all the other asset classes in there. So when they go back and meet with the IC, which is how we run, our business is run a little bit different to some other managers that just have, say, 1 to 2 portfolio managers and they make all the key decisions. We do it more on a consultative basis, whereby our team meets, they'll talk about ideas, they'll talk about the thesis for these names. And the benefit to having the analysts sit across multiple different sub-asset classes is that they can then compare jurisdictions, compare regulators and the like, and help build out the core stocks in the portfolio. So if you get to our, say, income and value strategies, we're probably left with around about, I think at the moment, mid-30 names in those two portfolios. So once we factor in risk of the names, we factor in the cash flows, the true infrastructure of the assets and the quality of the assets, that it leaves us with around about 35 names in the portfolio on average. So risk for us, you can see it there on the graph, is one of the things that is quite important to us when we're selecting stocks. So again, if we think about domestically in Australia, there's probably better risk-adjusted returns globally versus Australia. So it doesn't say we won't come back to Australia and local. It just means right now that's the approach we'll take. And I said before around communications, for example, same thing. If we think about the risk-adjusted returns to that investment, we'll follow where we think there's better risk-free return. Fantastic. Which again, for our investors and everyone online and yourself, Robert, that's what infrastructure should do. It's historically should be a fairly consistent performer. Like I said, sleepy asset class that's just going to tick along in the background.
But the upside here is that, as you said earlier, the earnings growth now is 4 times what it historically has been. So it's more than just a sleepy asset class. So that gives us...
It is now. Yeah, it's no longer an asset class that people can just gloss over.
Yeah, so what's also really interesting is you look back on history, even when it was a sleepy asset class, when the Federal Reserve paused rates and started cutting, there's this real outperformance. Did you want to explain that a little bit more as well, please?
I might use it as a bit of a catalyst to talk to the US a little bit, just looking at the US election that occurred obviously relatively recently. We'll see a new administration in January. What does that mean for us? Being quite US-centric and US-focused as a manager, long-term, we're not concerned about it. Infrastructure are long-term assets. We're going back to that kind of valuation graph and process that you had up before. We're mapping out the assets on around about, say, a 30-year discounted cash flow basis. A 4-year term realistically shouldn't have a significant impact in what these assets do. That being said, there will be some short-term noise in the US in, call it, the next 3 to 4 months, which will represent some really good opportunities in terms of purchasing opportunities. For us, utilities, they'll still perform, or they should still perform quite well. Again, they are an essential service. So despite who sits in the White House, people still drive to work, people still need power. all those things. So we're pretty confident that they'll tick along nicely. And we saw, obviously, straight after the election, the Fed come out and reduce interest rates. So what that tells us is that the Fed, they're certainly not looking at what will be in the White House. They're looking at more macro of the US. They don't want to predict what the Trump administration will do. I don't think anyone can really predict what the Trump administration will do. So I think the US has come out and said, all right, we need to start our easing cycle, despite what may look like a potential inflationary environment with Trump coming in with a few of his policies, which that probably tells us that, and for infrastructure tells us that there's, again, really good opportunity for our assets to continue that growth, and the spend and the capex will be cheaper moving forward in the US. So these projects that were placed on hold, say for communications or in renewables, they will certainly, hopefully, start to come to fruition. So this graph that you've got up here, Rob, is something that we've monitored for quite some time internally as those rates have peaked, and certainly as they start to come off. And we don't need rates to go back to all-time lows, Rob. We just need them to remain fairly consistent going forwards. There's still some really good opportunities that we see. And the other thing as well that I will touch on is just those tariffs that Trump may impose on the world. And whilst it's not great for the end consumers like you and I, Rob, it does mean that there'll be probably rebuttal tariffs, if I can put it like that, or some friendly tariffs posed from, say, Europe back on the US. So the end consumers will end up paying for that. But it does mean that in the US, that there still is some really good opportunities.
Yeah, great. And I know, and just in conclusion here, internally, you guys measure your portfolio and project or forecast the internal rate of return over a 5-year period per annum. Can you explain this chart here that we're looking at?
Yeah, sure. So the first thing I would note is, as you can see, this is as at 30th of September. I wasn't able to get the updated graph across prior to today, but the IRR is currently sitting at 13% for the income strategy. So it's actually slightly higher than 12.3. What this is, in effect, an average of all the names in our portfolio and their expected nominal returns. So what our analysts do is, when they're building out the portfolio, they give a required rate of return to the names, which comes out or includes things like cost of capital, ESG scores, dividend growth, dividend projections over a 5-year period. And what it tells us after this calculations are all done is what the nominal IRR will be. So this, in effect, shows us that over the next 5 years, we're predicting, again, no guarantees,
the forecast,
that the IRR in the strategy, nominal IRR before fees and taxes, will be in and around about 13% per annum for the next 5 years. It is slightly above historic averages, which is that blue dotted line that you can see that sits just below 12%. Yep. So it's slightly above historic averages, which tells us that valuations right now are extremely attractive with the names that we're looking at. So to your question before, Rob, valuations being recognised by the market, there's still certainly a lot of upside for us. We historically track this IRR pretty closely in the income strategy as well. The biggest takeaway for us is that we think there's really good upside still to be had despite this year's brilliant performance of the asset class. Yes, it's come off a little bit. Probably about 6 months ago, the IRR in the income strategy was sitting at around about 15%. So it has come back and pulled back a little bit because we've realised some of that upside in the last, as I say, 5 to 6 months. But again, still really good upside.
Yeah, and there's no guarantee in this, obviously, but the targeted return, where the fair value of where this asset class should sit, is annualized return of 8% to 10%, and it's currently sitting at around 13%. So we can see that, as I've indicated in my previous communications, there are some mispriced assets at the moment in the world, and global infrastructure is one of those. Again, this is not advice. This is just our observation, and we're doing some really good work behind the scenes to maximize that. But Devin, in conclusion, infrastructure is a defensive asset class, and it's the first time in a long time where we've actually seen earnings growth and structural growth that we have not seen these tailwinds before for this asset class. Valuation is quite compelling. And by having active management that can identify the top 200, then scale it back down to 30 to 40 stocks in a portfolio, globally exposed, identifying where the opportunities might be, is a real case in point, and credit to the team at ClearBridge. So Devin O'Keefe, thank you so much for your time. And if there's any additional questions, happy for anyone to come back through to me or directly to Devin, and we can answer those. So thanks very much, Devin, for your time.
No worries at all. Thank you very much for having me. And of course, any questions, here to help.
Thanks, mate.
And appreciate the support.
Cheers.